The office boom is over. In fact, many downtown towers across America and beyond are becoming modern mausoleums, empty shells of what they used to be. Some cities are watching their tax base erode, new leases vanish, and once prized skyscrapers fall into disrepair. Meanwhile, others are quietly rising. Smaller cities, rural hubs, hybrid office nodes, mixed-use developments. But which ones will survive, and which ones are crashing? In today's video, we're going deep on the tectonic shift reshaping commercial real estate, why remote work is no longer a flash in the pan, how it is hollowing out office markets where new demand is rising instead, and exactly which markets are booming or collapsing right now. Stick around. You'll want to comment your city and see whether it's winning or losing. Let's start with the biggest shift. Remote and hybrid work are here to stay, permanently altering corporate footprints. Before the pandemic, remote work was more of a fringe benefit, often restricted to a few roles. But COVID pushed even the most reluctant firms into remote-first or hybrid models. And now, years later, the data confirms this was no one-off experiment. It's structural. As of August 2025, about 22.1% of U.S. workers report working from home regularly. Studies show that many workers would quit rather than return to full-time office mandates. According to Chicago Booth, office occupancy dropped sharply during the pandemic and has only partially recovered. Many markets remain at just half or less of their pre-COVID levels. The decline in demand is deeper in properties that are older, lower quality, or lacking modern amenities. Tenants now preferentially seek flight to quality buildings. What that means is, companies don't need as much space. They renegotiate leases, sublease unused square footage, or simply shrink their footprints. Vacancies pile up, rents decline, and landlords feel the squeeze. Some analysts peg the drop in U.S. office value from 2019 to 2023 at over $550 billion in aggregate. And projections suggest that in big markets like New York, values could land 47% to 67% below 2019 levels by 2030, depending on how much further remote work penetrates. This isn't a cyclic downturn, it's a paradigm shift. To understand which markets get crushed and which survive, we have to trace how the disruption unfolds. Lease expirations and delayed renewals. Office leases are long, 5 to 10 plus years. That means many tenants are locked in through the short term, insulating owners temporarily. But when leases come up for renewal, companies often downsize or don't renew at all. This produces a slowly unfolding drip of vacancy rather than a crash. Subleasing flood firms vacate space before their lease ends and sublet it, often at heavy discounts. That pushes downward pressure on market rents and accelerates oversupply. Flight to quality. Bifurcation tenants increasingly discriminate. They prefer modern, efficient, amenitized, ESG-friendly offices. Class A buildings may see less deterioration. Class B and C buildings risk obsolescence, demolition, and conversion, a turning point. In some major U.S. markets, more office space is now being demolished or converted into other uses, residential mixed use, than is being built. That's a signal that the market is being recalibrated. Public finance. Urban feedback loops. Some researchers, notably Stein van Nieuwerburg, describe an urban doom loop. Remote work weakens office demand, reducing real estate tax revenues. That forces cities to cut services, making them less attractive. People leave. Foot traffic and retail demand collapse. Interest rates and debt stress. Many commercial properties rely on floating rate debt or refinancing. Rising interest rates make debt burdens heavier. Some properties were underwritten pre-pandemic, assuming stable occupancy. Now those models break. All of these forces stack up. The decline is slow, messy, and painfully structural. Now let's zoom in. Which markets are collapsing or on the brink? San Francisco/Bay Area. San Francisco is arguably ground zero. Office vacancy rates have soared, approaching 37% in Q1 2024. Its tech dependency, high costs, and heavy adoption of remote work combine for maximum damage. New York/Manhattan. The Big Apple's office sector is bleeding value. Some models show 30 to 40% of Manhattan office supply could be repurposed into housing to arrest the slide. The urban doom loop effect is strong here, hitting retail, transit, and services hard. Downtown Chicago is facing a contraction in commercial real estate, rising vacancy, and a slew of companies relocating or reducing office presence. Its deep reliance on central business districts makes the shift painful. Secondary decline markets. Cities with weaker growth engines, declining populations, or lack of diversified industries are especially vulnerable. Midwestern or Rust Belt downtowns already straining under shrinking tax bases may see cascading declines. Another indicator, markets that built aggressively before COVID, expecting continued expansion, now are overbuilt. They face persistent oversupply in the face of shrinking demand. If you live in one of these high-cost, high-density coastal markets, your downtown skyline may look very different in a decade. If some cities collapse, others are quietly rising. Remote work unlocks demand in fresh geographies and allows creative reuse of real estate. Here are the winners: suburbs, exurbs, and Zoom towns. Remote workers are relocating to less dense, more affordable places. These places combine quality of life, lower cost of living, and decent connectivity. They are often dubbed Zoom towns. This trend pushes demand toward mixed-use suburban nodes, neighborhood offices, retail clusters, and local co-working. Retail, restaurants, and experiential services in these suburbs gain tailwinds. Sunbelt and growth cities in Texas, Florida, Arizona, Tennessee, and other Sunbelt states are attracting population and businesses fleeing high taxes and high cost of living markets. These cities often combine favorable business climates, lower real estate costs, and growing infrastructure. Remote workers see them as suitable home base options, mixed use and adaptive reuse. Some office towers won't remain offices. Conversions to residential, hotel, or hybrid live work use are already underway in major metros. Buildings with flexible floor plates, higher ceilings, and good infrastructure may convert or reposition. Co-working, flexible office, satellite hubs. Instead of sprawling central offices, companies are opting for satellite hubs, micro-offices, and co-working nodes in multiple neighborhoods or secondary cities. Landlords and developers responding to that can benefit. Industrial, logistics, data, and infrastructure, real estate. The rise in e-commerce and supply chain localization has driven enormous demand for warehouses, last-mile logistics, and data centers. These assets are far less exposed to the remote work office collapse. Tier 2 and regional tech markets, places like Austin, Nashville, Denver, Portland, Oregon, Raleigh, and others are seeing influx of tech activity and benefiting from being more affordable than coastal hubs. Remote workers, startups, and companies seeking to cut costs find these appealing. So the winners are not the densest downtowns, but the nodes and corridors that blend flexibility, infrastructure, quality of life, and connectivity. Now let's zoom out and paint the bigger picture. Which markets are actually collapsing? And which ones are booming? Let's start with the losers. San Francisco is ground zero. Vacancy rates there have exploded, hitting levels that would have been unthinkable just a few years ago. Entire towers sit half empty, and downtown feels hollowed out. For a city once seen as the global hub of innovation, it's a dramatic fall. New York isn't far behind. Manhattan has lost billions in office value, and experts warn that as much as 1/3 of its office stock may need to be converted into housing or completely reimagined. If you've walked through Midtown lately, you've probably noticed the signs: more empty storefronts, less foot traffic, and buildings with big, available banners. Chicago's story is just as worrying. The iconic skyline still looks strong, but inside those towers, vacancy rates are climbing and companies are pulling out. That puts pressure not just on landlords, but also on the entire ecosystem that depends on office workers, coffee shops, restaurants, transit, and even city tax revenues. Now, while those markets struggle, let's look at the winners. Smaller cities, suburbs, and what some call Zoom towns are thriving. These are places where remote workers have relocated for better quality of life, lower costs, and more space. Imagine someone leaving New York and moving to Raleigh, Austin, or Denver. Suddenly, their salary stretches further, they get a backyard, and they're still connected digitally. The Sun Belt is another hotspot. Cities like Austin, Miami, Nashville, and Phoenix are booming as workers and companies migrate from high-cost coastal hubs. They offer sunshine, affordability, and a friendlier business climate, and remote work has only accelerated that shift. And then there's the shift in real estate itself. Old office towers are being reborn as apartments, hotels, or mixed-use spaces with shops, gyms, and co-working areas all under one roof. At the same time, industrial and logistics properties are red hot. Warehouses, data centers, and last-mile delivery hubs are thriving in today's e-commerce-driven economy. So when you look at the map, it's clear. Big coastal hubs are in decline, while suburban nodes, Sunbelt cities, and adaptive reuse projects are rising. It's not that offices are dead, it's that the location and purpose of those spaces are changing. The bottom line, if you're investing, don't bet blindly on traditional downtown towers. The future is in flexible, mixed-use, people-focused spaces in the right markets. If you're an investor, real estate developer, or urban planner, what should you do? Stress test your assumptions. Underwrite for scenario where office occupancy is 40 to 60% lower than 2019 norms. Model conversion viability. Select markets carefully, favor markets with positive population growth, strong industry diversification, affordable cost base, quality infrastructure, and favorable policies. Focus on quality, flexibility, and amenities. Buildings that can flex, high ceilings, column spacing, multi-use floors, good HVAC, daylighting, will have better longevity. Offer amenities that draw people in. Wellness spaces, outdoor terraces, collaboration zones. Plan adaptive reuse, identify which buildings are conversion candidates. Be ready to pivot office to residential, education, health, or hospitality uses. Invest in backbone infrastructure. Think beyond the building: fiber, power, cooling, microgrid, mobility connectivity. Remote work users demand high reliability. Pursue satellite hubs and suburban nodes. Buy or develop smaller footprints in growth corridors, not just central business districts. Deal with debt wisely. Refinance before conditions worsen. Shift to fixed-rate debt. Avoid over-leveraging legacy office assets. Engage cities and policymakers. Push for zoning flexibility, incentives for reuse, tax credits for conversions, infrastructure support. Cities that accommodate change will be winners. Cities themselves must adapt. Reposition downtowns, reimagine mobility, densify housing near transit, incent mixed use and local services. This transition is far from predictable. Some key risk factors and wildcards: return to office rebound. If corporate culture swings back, demand could recover, though that seems unlikely on large scale. Macroeconomic volatility, interest rates, rising rates, or credit crunches could make even good deals unviable. Technological disruption, advances in AR/VR, distributed computing, AI, augmented presence may alter how much physical space people want. Policy shifts and incentives, stimulus, tax changes, incentives for redevelopment or affordable housing could accelerate conversions. Local shocks, natural disasters, transport changes, crime, taxes, local quality of life can tip a city from boom to bust, or vice versa. In sum, be agile, hedge for downside, and be positioned in markets with optionality. So where does that leave us? The office boom is over. Some high-cost, high-density downtowns will struggle to remain the magnets they once were. But the shift opens new frontiers: suburban hubs, smaller cities, mixed-use corridors, conversions, and infrastructure-driven growth. If you live in one of these markets or are investing there, take stock. Ask, is my city collapsing or quietly rising? Are my investments future-proof? What flex options do I have? I want to hear from you. Where are you based? Do you see vacancies, conversions, new construction? Drop your city in the comments and let's map which places are winning and losing in real time. If you enjoyed this deep dive and want more insights into the intersection of real estate, remote work, and money, make sure to subscribe, hit the bell, and join this community. We have lots more coming. Thanks for watching. I'll see you in the next video.